Markets slip on continued concerns over monetary tightening in the US and its impact across asset classes and currencies. Financial, autos and utilities lead the decline, while IT and healthcare buck the trend.
Tata Steel says it will merge its listed subsidiaries to simplify the group structure, plug value leakages and exploit synergies. CFO Kaushik Chatterjee tells CNBC TV18 the move is EPS accretive.
Mahindra Finance slumps after the Reserve Bank of India asks it to stop using recovery agents following the tragic incident that took place a few days ago. The company says it does not expect this order to impact its collections.
Accenture guides for an 8 to 11% growth in FY23, far lower than the last year's 26%. But analysts see this as still above pre-COVID levels and positive cues given the recent tempering of expectations. Indian IT stocks power up. A depreciating rupee also boosts the sentiment.
And the rupee hits fresh lows on the dollar, buying by foreign funds seeking to exit equities after the US Fed indicated peak rates could go to 4.6%. Dealers say RBI has been offering dollars to counter the buying pressure. Indian bond yields surge further in step with the US yields.
Hello and welcome. You're watching us here on Halftime Report. I'm Manglam Malu, with me Sonia Shenoy as well as Ekta Batra. For the third day running, we're seeing some weakness in our markets, and as we speak, the Nifty is sitting with a cut of almost 175 odd points. But the worry for the last 2 days in particular has been the underperformance of the Nifty Bank. As we speak, the Nifty Bank is down 850 points and broke below the 20-day moving average as well. The Nifty is not falling as much, primarily because the IT and Pharma pack is supporting it. But I think the weakness in the rupee is affecting the macros, and that's what's reflecting in the kind of FII outflows that we're seeing and the Nifty Bank.
Oh, absolutely. And it's the overarching rate hike cycle, right? Not just the US Fed. Next week on Friday, you have the RBI policy as well. And there is an expectation that there will now be a 50 basis points rate hike by the RBI and perhaps a cautious stance there. In fact, this morning, Goldman Sachs just raised their rate hike expectations to 50 basis points. So that seems to be the chatter. And perhaps that's the reason why most of the market is under pressure. Banks are under pressure. It's something that you just can't escape. Of course, India has been very resilient, but there's a big event upon us. There's also the US GDP data that comes out on the 29th of September. So lots to reckon with.
Hi Sonia, hi Manglam. Yes, absolutely. For the macros, I think that really stands out. The rupee at 81 is just going to become more expensive to buy those tickets to travel abroad. But nonetheless, that's on the rupee. But I just want to point out that even Singapore's inflation rate is the highest that we've seen since 2008. Bank of England, their rates are the highest since November 2008. So you can get a sense in terms of what the rate cycle is going to be globally. We've already spoken about the US Fed, and like Sonia mentioned, it is going to be the Reserve Bank of India where there's a possibility that 50 basis points in terms of a rate hike could be on the cards. Remember, the previous inflation figure that we had to reckon with was at 7% after 2 consecutive figures of a sub 7% figure. So yes, macros is top of mind. But let's focus on a couple of stocks in news. Mahindra Finance has slumped after the Reserve Bank of India asks it to stop using recovery agents. We have Abhishek Kothari joining in with the details on this story.
Well, Ekta, as you mentioned, RBI has taken action against M&M Finance, and they have directed M&M Finance to stop recovery operations via third party or, till further orders. So M&M Finance can carry out the repossession and recovery mechanism via their own employees. They have an employee base of close to 19,750 odd number. So M&M Finance has come out with clarification. They did mention that they have stopped using third party repossessions, and they'll wait for RBI clarification, on how and when they can use third-party agents in the future. However, they have also given a number that the repossession of 3,000 to 4,000 vehicles will get impacted on the overall 4,000 to 5,000 repossession that they do every month. So this is around close to 60-80% of the repossessions can get impacted. We also reached out to Shriram Transport, who told us that all their disbursements and recovery are done in-house and no vehicle, repossession is done via third party. We reached out to Cholamandalam as well. They say that they have 13,000 in-house employees for collections and recovery, and only 1,500 external agents are there. When they go out for recovery, they are accompanied by their own set of employees as well, or the in-house employees. Back to you.
Okay, thanks a lot for that. So that's on a couple of these stocks. But a whole host of pharma stocks have also been in focus today. Ekta, what are you tracking?
Well, yes, there's a lot of US FDA action. So I'm going to start with the big boy Cipla. That stock is in focus. That is because they've received an establishment inspection report for their Indore facility. This is post a pre-approval inspection, which is basically a product-linked inspection, which had taken place earlier this year. So it is positive news for Cipla, considering that they do have an overhang from their Goa facility. Glenmark Pharma is in focus because their Baddi plant still continues to be under the scanner. To give you a background, this particular plant was inspected by the US FDA in 2019. It was issued an official action indicated status, a warning letter at that point in time, re-inspected in June 2022, received 6 observations at that point, and the US FDA is not satisfied. The official action indicated status remains for Glenmark. And in fact, just to probably cushion the stock a little bit, we have the Aurangabad facility, which has received an EIR. Shilpa Medicare, one of their facilities, which is basically a testing laboratory, has received an EIR, establishment inspection report from the US FDA, indicates closure of the inspection. Remember, one of their main facilities, which is based in Telangana, has been under an import alert by the US FDA, so maybe a little bit of a shot in the arm for them. Biocon, we've accessed the Form 483, which was issued to 2 of their facilities, which is basically their Bangalore facility and their Malaysia facility. Seems like it's going to be a tough road ahead for resolving the 11 observations which have been issued to the Bangalore facility. Lastly, Torrent Pharma, the Indra plant, is currently getting inspected as per sources, and it could possibly see a resolution. It was issued a warning letter in 2019. Resolution means completion of the inspection, not resolution of the plant, but nonetheless, that's something to track as well.
All right, Ekta, thanks a lot for that. So that's about the pharmaceutical space, but moving diametrically opposite from pharma, I'm just looking at ITC's outperformance, and that's caused a bit of a rub-off in all the other tobacco companies as well. Case in point, Godfrey Phillips. The intraday chart of Godfrey Phillips should come up for you, up around 3.5% as we speak. This week itself, while ITC has rallied about 5%, and it's perilously close to its all-time high, Godfrey Phillips is actually one stock which is rallied about 7% as well. So if the thesis is that tobacco consumption is back to pre-COVID levels and is growing beyond that as formal sector is gaining more market share versus the informal sector, then perhaps these are the other stocks that one would be looking at as well. But let's move back to the top story this morning. The board of Tata Steel has approved the merger of 7 Tata Group metal companies with Tata Steel. Listed entities include the likes of Tata Steel Long Products, Tin Plate, Tata Metallics and TRF. Nigel stands by at the big wall to tell us more. Nigel.
Well, the long-awaited big consolidation drive at Tata Steel has finally been announced, with listed entities like Tata Steel Long Products, Tin Plate, as well as Tata Metallics to be merged with its parent, that's Tata Steel. Tata Steel has majority stakes in most companies, though in TRF, they have just around 34% stake. Now, the merger ratios that were announced, they come up for you on the screen, and they were more or less in line, barring TRF as well as Tata Steel Longs, where the merger ratio was unfavorable, which explains why both those 2 stocks are under pressure post the big run-up we have seen in the last couple of weeks to around a month. Additionally, Tata Metallics is also, smashed in trade, as the street believes, since bulk of its EBITDA is from the non-commoditized DI pipes business. It could potentially get higher valuations, but that's not the case just going by the merger ratio. The benefits include simplification of the group structure as well as synergy benefits. But getting to the key benefit then, as of now, Tata Steel Longs as well as Metallics, they procure their iron ore from Tata Steel, and they have to pay close to around 22.5% additional royalty on this purchase, which now gets eliminated post this merger. Additionally, Tata Steel Long's balance sheet, well, it got stretched post the NINL acquisition, so the merger is a step in the right direction. We spoke to the management earlier today, and Mr. Kaushik Chatterjee said that the merger will be EPS accretive, and also said that there will be more than 1,500 crores of cost savings or synergy benefits due to this amalgamation, bulk of which will come in on the royalty aspect. On that note, though, let's hear out what they had to tell us earlier today.
After successfully merging and integrating Bhushan Steel, it was logical for us to look at the other subsidiaries which are of strategic relevance. And I think with these companies, all of these companies have, the businesses actually have a great future going forward. So first of all, it will be a simplification. And we have in the last 4-5 years taken out across Tata Steel Group about 120 companies. All of these are obviously EPS accretive for Tata Steel standalone. On the other hand, all of these were anyway consolidated because these were all subsidiaries. So after we the minority shareholders, the minority interest part gets absorbed. But otherwise, they were on its own already being part of the consolidated balance sheet of Tata Steel. So that's less of a point. The more important point is to drive the business in the future. And I think that is what will reflect very clearly on the Tata Steel balance sheet. And when I say Tata Steel, I'm always looking at consolidated balance sheet because that's the most relevant one. Annually, the annual number is close to 700-800 crores.
So I'm assuming that if this was a benefit of 700-800 crores, and if that's less than 50% of the benefit, then overall the synergy benefits will be in excess of around 1,500 crores.
On an NPV basis.
Okay, that was a big story of the day, Tata Steel, and the kind of cost savings that they have because of the synergies post the amalgamation. But keep an eye out on the market. Low point of trade right now, the Sensex down over 1% and counting. The mid-caps also under pressure. But what's also under pressure is the rupee. It opened at a record low. It breached the 81 mark. Lata joins in with the analysis. Lata.
By midday, the story of the rupee turned a bit. There has been a decent recovery after starting as low as 81.1, going to a low of 81.2. The currency saw a significant amount of recovery, and dealers are attributing it to a huge intervention by the Reserve Bank. People are not putting numbers, probably $1 billion or something, but clearly the tide has turned. What has also helped the currency is the fact that the dollar index appears to have peaked off for now. From almost going to 112, the dollar index has moved towards the 111 mark. But things are very much in a state of flux. Forex market is watching out whether the Fed rate hike is actually triggering a sustained sale of equities by foreign funds. If they do that, they will come into the FX market to buy dollars. And they're also watching out for where the Reserve Bank finds its comfort zone. The big question in the market is 81 the new 80? That is, will RBI defend 81?
Okay, all right, Lata, thanks very much for that. So 80.95 currently for the rupee and had hit 81 on an intraday basis, as you can see. But a depreciating rupee is also boosting the sentiment of Indian IT companies. IT stocks are surging. On the other side, Sandeep Agarwal of Edelweiss Securities will be with us to put the focus on the IT sector and to also give us his perspective on Accenture numbers. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. Just a quick word on the market. It's still down, but the low point of trade right now, but 17,400 is not breaking, at least as of now. There's quite a bit of pressure in the Bank Nifty. The Bank Nifty is down almost 1,000 points as we speak. IndusInd, HDFC Bank, HDFC, Axis Bank are all under pressure right now. So do keep an eye out on that. Of course, the entire IT space is in focus after Accenture's guidance that came out. Sandeep Agarwal, who tracks IT at Edelweiss, joins us now to talk more about that. Sandeep, welcome to the show. How would you read into the moderation in the guidance? I mean, it's quite significant, right? 8 to 11% now versus the 26% growth of last year. Is Accenture just being conservative because of what is perhaps to come, the impending recession? And what would your read-through be for the large-cap IT space?
Yeah, thanks, Sonia, for being me on the show. Two things. If you see Accenture past track record, they always underguide by 4 to 5% on average. So if you see last year 26, the guidance was much lower than that. So that is number one. Number two, we always go by what are the internals of the numbers. So if you see the internals of the number, and we have been saying this several times in last 2 years that directly correlating the GDP growth rate doesn't help, because outsourcing is the last one to get cut. So if you see Europe economy, while is not doing so great, but if you see growth for Accenture in Europe has been superb, and they are seeing growth from all markets. So we have to see everything in perspective. Technology is no more a operational efficiency or cost takeout function. It is more of a revenue driving function, profitability driving function, and secondly, it is core to the business. So I think, we should not simply take growth of guidance of Accenture. I also have to remember that last year was an exceptional year where, prior to that year, there was a base effect as well, which we will not get that benefit this year. And obviously, because of that, if you see the estimates for Edelweiss or for anyone else is lower than the previous year, obviously, because that was one-off year. But will the industry do extremely well for the next 2-3 years? That call remains there. So I don't have any doubt, and I don't read anything negative in the numbers. I think it is a good number, good guidance, and there is a lot of optimism which is there. Obviously, optimism is with little caution, because they also need to see how things pan out on the economic front in the largest market, that is US.
Sandeep, I wanted to digress a little bit from Accenture and ask you about Europe. It's around 25% of total sales of the bigger IT companies. Now, with the fact that there are these recession headwinds, the Bank of England already said that they think they're already in a recession, and this higher interest rate environment that we're already working in. Are you factoring that in terms of your numbers? How much of a slowdown do you expect, impact do you expect on numbers?
See, there are two things. When we have interacted recently to the banking side, banking sector, what we have come to know that, in fact, for most of the tech companies, the banking segment is doing quite well. Where we are seeing pressure of recession or some hint of that is on the retail side, which you would have seen that all the global retailers have brought down their guidance or the outlook to some extent. So that is where there is some pressure. There is no denial about it. But otherwise, other than retail, we are not seeing any signs of pressure anywhere. And in fact, banking is doing better than expected. So from overall growth perspective, I think we are not yet building in any decline in growth. We are still believing that 13 to 15% kind of growth for most of the good quality large and mid cap should be there. So we believe that HCL or Infosys or TCS should be in that range of 13 to 15% kind of growth, and the good quality mid caps like Mindtree, LTI, Coforge, they should be between 18 to 22% kind of growth. We don't see material risk in those numbers, because one, hyperscaler continues to spend a lot of money, and second, demand environment is quite robust. So we are not seeing any signs of any weakness from the banking side as well in any of the companies as of now.
Right. Sandeep, back in the day, we would see strong inverse correlation with the rupee and the IT stocks. The weaker the rupee got, the stronger the IT stocks went as well. But that seems to have changed over the last few years as companies get more diversified in their services, etc. Just wanted to understand from an Accenture perspective, what areas of Accenture do we have major overlaps with in Indian companies? And to that extent, how do you read these numbers for specific companies in India?
So see, 50%, almost 52% of the book is outsourcing, which is apple to apple comparable with Indian IT. And if you see in that book, the interesting thing in the guidance, if you do a detailed research of what they are saying, is that they are guiding for double-digit growth confidently in the outsourcing piece, and a low double-digit or a high single-digit in the consulting. So that is very, very interesting, and that is very positive for Indian IT. That is the way we read. So the overlap is in 50% of Accenture's business, which is the outsourcing piece. And in consulting, probably we have a 5 to 10% overlap, not more than that.
Okay. I just have to ask you what one should be doing with Infosys now. It's becoming very hard to keep the faith, right, with the way Infosys is moving. I mean, fresh 52-week low. But to be fair, the company is very confident of holding on to their FY23 revenue guidance of 14 to 16%. So what's the way forward now for an investor who perhaps is holding the stock?
So see, the point is that 14 to 16% is something which people have not built in for Infosys. So the built-in is for 18 to 20%. So if they do 14 to 16 and for this year, then probably the stock can't be at 1650, 1700. It has to be at 1400 odd level. So that is where the market is pricing in. And secondly, market is also worried about how they will guide for the next year. So if you see Accenture, for example, they have guide down by 4% on an average versus their guidance last year. And so last year, if you see, they have outperformed, they have overshot their guidance by almost 10% in actuals. Same thing we are seeing in Infosys for last year, what they guided and where they ended this year also. We are seeing some increase they have done. But the question which investors have in mind, what will they guide for FY23? So if they end up at doing 16%, then obviously, they will not guide more than 11-12% for the next year. And that is what the worry is today. And secondly, I think, on attrition, their commentary still is not very optimistic, which I think after this quarter numbers, you will see that, attrition has started cooling off. Once that starts cooling off, the margin pressure will ease substantially. So I think these are the 2 points where there is a confusion.
Okay, all right. That's an emphasis, but I just wanted to ask you about your thoughts on KPIT Technologies, that surge that we saw in KPIT yesterday after that 640 crore acquisition that they made. What about the acquisition did the street like, and how would you approach the stock? There are brokerages with a target price of around 900 on that.
See, we don't have an official coverage on KPIT, but I would say that, the R&D space is least penetrated and there is a lot of demand in that space. And also we are seeing incremental demand right now because of EPAM's fallout, because as they are not able to execute because of the Ukraine-Russia conflict. So I think once that number goes out, then probably you will have a more clearer picture. I think all the R&D companies right now are beneficiary of the of EPAM's fallout on the execution front. And so I would be a little cautious in the R&D space temporarily. It is a structurally very good story. But the likes of Tata Elxsi at 10,000 and KPIT at 650 and LTTS, all this can, correct from here in near term, because after 1 or 2 quarters, you will see the right growth numbers. And that's why we are preferring right now IT services. I think IT services, there is a lot of value even in large cap, mid cap, small cap. And that is what should be bought with a 6 to 12 months investment horizon. Definitely there is a lot of money to be made. But I would prefer IT services over ER&D right now.
Your point, Sandeep, and apart from the global growth slowdown along with the Accenture numbers, the other issue that's plaguing the industry right now, which is very specific, is the moonlighting issue. We had, Wipro, ask 300 people to resign because of moonlighting, etc. So do you think these things would have any problem in the near term for all these companies with regards to employee costs or onboarding people, attrition-related issues?
No, I think it is unethical to do that. In my view, means if you should not do it, because not only from the employee's personal perspective, but I think you are handling data of 2 different companies and 2 different set of clients. So it is completely unethical. It can lead to severe losses for the companies for which the employee is working. So I think moonlighting is a real issue and it has to be addressed and it has to be stopped. So I don't think it will have any impact on attrition. The attrition in the industry is cooling off substantially because startups were taking a lot of people and hyperscalers were directly recruiting a lot of people from India, which I think has cooled off substantially. So you will see substantial relief in the quarterly attrition number when this quarter number comes, and that will reflect in margins as well. So you will see margins improving for the whole sector, and this moonlighting issue, I think, will stop in next 1 or 2 quarters.
Just a small follow-up on that one. I just wanted to understand, with the conversations that you've had with a lot of companies, etc., would you have a broad sense of what proportion of employees would be moonlighting, etc., for companies? I mean, just a ballpark, any anecdotal conversation that you've had?
So see, no company has given any number and I have not spoken specifically on that, but I can tell you that, a rough estimate suggests 1,200, 1,300 employees is max, which will be moonlighting amongst the large cap. In small caps, you can't track them because, many of them are on subcontracting, contracting and all. So it is very difficult to put a number on that because we don't know the contractual obligations. But full-time employees on large cap should be 1,200, 1,300, which would be moonlighting. And after this incident of Wipro and all, I think it will stop. In next 1 or 2 months, you will not have any specific
I think also Wipro, Rishad Premji's main angst was, not just moonlighting where you're doing work for other industries, but doing work for competitors, right? That is the big problem. I mean, how can you do that? So I guess that was the big angst that...
like Sandeep said, there's going to be an absolute stop to it now, considering what Wipro did. So that should put an end to it.
All right, that should put an end to it. And that also brings us... Yeah, please go ahead.
So I'm saying it is absolutely unethical because you are dealing with data of different clients, which is not allowed, right?
Yeah.
So it is a very serious issue.
Take your point, Sandeep. Thank you so much. Always a pleasure speaking with you. Thank you for speaking on a whole host of issues with regards to IT and IT services. You do like the IT services companies from a 6 to 12 month perspective. With that, we'll step into a short break. On the other side, we'll get in Prakash Gaba to talk about some trading strategies that he's lined up for us.
Welcome back. Well, it's a rough ride for the markets at this point in time, but a couple of stocks which are managing to buck the trend. So Divi's Lab stands out. That one is your top gain on the Nifty at this point in time. But you got to put it into perspective because that stock is higher by only around 10% from its 52-week low of around 3,365 rupees. And if you compare it to its 52-week high, it's significantly lower. 52-week high stood at around 5,425 rupees for Divi's. So there's still some amount of catch up which needs to be done. But let's talk about the technicals on a weekday. Prakash Gaba joins in on the show to discuss what he's strategizing. Prakash, hi, welcome to the show. It's a rough ride for us today and it's the end of the week. So what would you recommend to your clients in terms of positions?
Well, good afternoon to you. Yes, it is certainly is a rough ride. End of the week, if Friday closes low, the next week seems to be closing low as well. So that's my worry. The real issue is it going to close above 17,500? It looks less likely now. If it closes above 17,500, then there is some kind of a hope that next week should be okay. But it looks like it's weak. So one can still short it here. Only thing is stop needs to be a deep higher here. I would say that stop above 17,500 should be okay, but and perhaps we can see lower levels today. Looks like. So Nifty and Bank Nifty both look weak.
How low can we go, Prakash, from here? And what are the stocks that one should be in then to protect one's capital?
Well, 17,415 is trading now Nifty. Next logical technical targets would be psychological 17,000. I think if it slides down, maybe in the days to come, we could see around 17,000 coming in. Bank Nifty is 39,644, has broken the crucial psychological 40,000 mark. So I think it's going to 39,000, maybe lower than that, who knows. But so far, both look weak to me. However, we need to be stock specific. Stocks that I think I like Ambuja Cement on the long side. Looks good to me. Showing some traction. Basic chart structure is positive. Saw some 3 days of correction. Yesterday and today's up move is there. So I would have a stop below 540 on Ambuja Cement and trade long here. Can it go to 580? Very good chance it can go to 575, 580 zone. Ambuja Cement. So we need to keep a eye on Ambuja Cement.
Okay. In fact, cement. Sure. Go ahead. What was the second call?
The second call I would say that is from the pharma pack. That is showing some traction today, the entire pharma pack. I would look at Sun Pharma. Trading at 924. Possibly it's heading to 940. Stop below 920. Just 4 rupees. That's good enough. It's make or break.
All right, thanks for that. So 2 stocks that are bucking the trend, but the market, look at that. It's at the lowest point of trade right now. As Prakash was saying, the Bank Nifty is now below 40,000 and the Nifty as well, 210 points gone. Let's do one thing. Let's take a break. Before we do that, here's some great news for investors. You can now track the US market action real time on Money Control. Log on to the Money Control website or the app and stay informed about all that matters in global markets. Welcome back to Halftime Report. There are plenty of stocks that are moving around, so we thought let's just, talk about all the buzzing stocks and get you some opinion as well. Don't lose sight of the market, which is now at the lowest point of trade. So Prakash Diwan is joining in. Prakash, first a word on Tata Steel, right? The big story of the day. The management told us that there will be 1,500 crores of cost savings because of this this amalgamation. But we all know that the problem still persists, right? I mean, steel prices are under pressure, demand is not that great. So what do you do with Tata Steel now?
Good afternoon, Sonia. So, I think the immediate reaction is going to be a little bit negative, if you ask me. While this whole reset is EPS accretive, typically what happens is every time people end up getting shares of a company that you originally didn't want or you didn't own, there is a tendency to kind of get out of it. And what makes Tata Steel also complex after this entire this thing, while there is simplification as an objective, is the fact that the PE multiples to some of these businesses like tin plate, Tata Metallics would have been far richer. What you get for a Tata Steel is more commodity conversion, and then that will probably continue. So yes, there will be some pressure, but on metals as a whole, I think there's a very clear immediate pause that we've seen in terms of price action, in terms of the export restrictions and all, but eventually, the commodity cycle will kind of take off if the recession fears are not deep enough, especially in Europe and US, given the fact that China also is not being able to ramp up production as largely as was anticipated earlier. So I'm quite positive on this space, but it will probably take some time for this consolidation in the sector and for this company specifically after these transactions are over. To happen, but you don't have to miss out on Tata Steel as a pick in your portfolio for sure. After this, you get so many of these good businesses coming together in one stock, which is remarkable.
Okay, it reminds me of fixed dose combination. You get multiple drugs in one tablet. But nonetheless, Prakash, I wanted your thoughts on M&M Finance. The fact that they can't use third-party recovery agents anymore. Stock is down around 11 to 12%. We've got clarifications from other companies that, Shriram Transport doesn't have any kind of exposure such as that. How would you approach M&M Finance? Do you think that is now going to underperform because of this simple reason, which is going to play out in the next couple of quarters?
Yes, Ekta. So, it's definitely a setback because 60 to 70% of collections for this company happens through third-party sources. And, the cost efficiencies of being able to manage multiple geographies, collections in multiple geographies is only possible through third-party businesses. You cannot expect that to happen with people on your own roster. And that's precisely why there's a huge difference in the way a Shriram Transport would do its business as compared to an M&M, which is into much more smaller locations, much more deeper geographies. And my submission in this is that there will be a solution to it with an added cost, right? So you'll have to live with that in terms of the recovery. If the recovery doesn't happen, then it's a significant balance sheet issue. But I don't think a company is as wise enough as M&M Financial would let that happen. So this is like the Maggie moment for M&M Financial. I mean, the business is good. They are expanding. This is a setback. They will have to spend on it. You know how Nestle had to do so much to overcome that debacle. It might be not as long drawn as that, but I'm sure they will take some time to get over it. But during that phase is when you get it at a softer valuation, and for long-term believers, that would probably be the opportunity.
So are you buying the dip on M&M Financial? And also, because of this issue with M&M Financial, we've seen a decline across the NBFC space in today's trading session. Case in point, Chola Investments is down about 5.5%. We have Shriram Transport down almost 4%. So it's basically started the sentiment, so to say, in the space itself. Would there be any attractive bets here, according to you?
So, Manglam, it definitely, this has happened with one company, which is unfortunate. The incident is definitely something that kind of calls for caution, and there could be a possibility that RBI might believe this is to be extended to everybody else as well. So that's one of the reasons why there will be a little bit of a time that there'll be some sort of a cost and time cost that will be incurred by most companies to set this off, right? The non-availability of third-party services. So from that perspective, you are getting that entry point in some of the good companies. To my understanding, Shriram Transport, Chola with such strong balance sheets definitely offers so much. In fact, Shriram Transport Finance with the pre-owned commercial vehicle segment revving up so much when you look at Ashok Leyland numbers, when you look at the overall logistics change that is happening. I think there's definitely great opportunity in those companies, but you cannot expect a recovery to be immediate. So if you buy today, you can't sell next week at a profit. You'll probably have to look at holding on to this for at least the next 1 year, one and a half years for all of those to play out. But I definitely like that space. It's far better than the gold financing and housing finance companies at this point in time.
Okay. Prakash, we were trying to get you on board, but you were traveling yesterday to discuss your thoughts with regards to Fortis. Would you buy that stock, or would you probably stay away? Would you buy it because of the fundamentals, the fact that the hospital business is improved, or would you stay away because of this entire amount of uncertainty on the open offer, which is now in its 4th year running?
So I think the issues.
Okay, Prakash.
I think it's a Fortis issue, because yesterday we asked him the Fortis. We tried him on Fortis and there was an issue, and now you asked him the Fortis question and there's again a scratchy line.
Maybe he just doesn't want to give his view on Fortis, guys. Can't you understand that?
Well played there, Prakash. Well played.
When technology supports you, right?
Yeah,
Okay.
some higher power for Fortis at this point.
Okay, he's back again. No, Prakash, we were asking about Fortis. Yesterday we couldn't reach out to you, and now as you started answering, there was an internet issue. Is it because you don't want to answer, or is there a higher power?
Okay, well, we got the answer to that, right? He doesn't want to answer, guys. He doesn't want to answer it. Okay, but just don't lose sight of the market. It's tanking, and how?
Yeah.
Just look at that. The mid-cap index is now down almost 500 points. The Bank Nifty is down almost 1,000 points. And it's not stopping at this 17,400 level. That could get breached anytime soon. It's an across-the-board secular move. So M&M, IndusInd Bank, HDFC Bank, Axis, all the gainers of the last many weeks are seeing some profits being taken off the table. So don't lose sight of what's happening on the screen.
When the market broke that 17,430 mark, which was the Monday low, it's only then we started accelerated selling. And now if we have to look for levels, the next level of support comes in at the 50-day moving average, which is 17,315. So the question is whether we go there or not. And as we speak, it's sub 17,400 for the Nifty itself. What we'll do is actually take a short break, come back, get you more on the markets and individual stocks, because a lot is selling off as we speak.
Welcome back. Well, no respite for the market. So let's focus on some companies then and some commentaries. IGL Management, in an exclusive conversation with CNBC TV 18 earlier this morning, tells us that they will look at acquiring smaller CGD companies in Maharashtra and Karnataka. Listen in to the company talking to us.
We have promised to deliver the lowest cost CNG to the consumers in the national capital territory. And in the short term, we can absorb any hikes. So we will not pass on to the consumers. We are working on two-pronged strategy to reduce our internal operating expenses and to maximize sales. There are some the CGD companies which are coming for sale. So we are aggressively going to bid for them so that we acquire new GAs in other areas and we become a pan-India company. As a strategy, IGL is looking to diversify to other areas. Wherever the new companies are coming up for sale, we will be bidding aggressively. We have already crossed 8 MMS AMD per day. And if we consider the sales growth based on historical basis, we are growing at a 13%.
Okay, so that's the IGL Management, but we need to take a short break. On the other side, we're going to be speaking about the rupee. The rupee is at a fresh record low today, but it is outperforming in our special series, FinStreet. Stay tuned.
Welcome back. We're just around that 17,400 mark for the Nifty. We dipped below that for a brief moment, and now the bulls are trying to, at least trying to defend that 17,400 mark. Let's see where we go from here. And, the rupee, despite it opening at a record low and breaching the 81 per dollar mark, it is seen to be the best performing currency as opposed to other peers like the ringgit or the yuan or even the euro since February this year. In our special series, FinStreet, my colleague Abhishek joins in to explain how the rupee maintains this outperformance. Abhishek.
Well, in FinStreet today, let's focus on rupee, which is the best performing currency from Feb 2022 to now, when compared to the likes of euro, ringgit or yuan. Now, forex reserves or foreign exchange reserves are the assets that are held by a central banks or monetary authority. It is generally held in reserve currencies like the US dollar and to a lesser extent like the euro, Japanese yen and pound sterling. It is used to back its liabilities like the native currency issued and also reserves which are deposited by financial institutions or the government with the central bank. So foreign exchange reserves are also a true barometer of a central bank's reserve management to ensure that the central bank has control over adequate foreign assets to meet the national objectives. Now, the objectives may include providing a level of confidence to the markets, backing the domestic currency, assisting the government to meet its forex needs and external debt obligation, while also maintaining a reserve for potential national disasters or emergencies and to keep the value of the currency stable. So countries with a floating exchange rate system may use forex reserve to keep the value of their currency lower than the US dollar. Let's take a look at RBI and its working. So RBI has managed the currency impact from the war that is between Russia and Ukraine or the current global macro situation. India has seen a massive decline in its forex reserves over the last few months. So in dollar terms, the forex reserves have declined by 12.8% from Feb 2022 to now. Value-wise, the forex reserves in India have declined from $632 billion to right now about $551 billion as of September. So its wonderful impact on rupee has been the fact that, rupee is the least depreciated currency. Rupee has depreciated only 6.5% against dollar versus an 8.5% depreciation that you are seeing for ringgit, almost 10% depreciation for yuan, while 12.7% depreciation that we are seeing euro versus the dollar. So impact of lower depreciation of rupee versus dollar is that lower currency depreciation helps in trying to curb the rise in inflation as it helps in reducing the cost of imported goods and materials. The impact of availability of money for government to spend also increases. It boosts exports and reduces sovereign debt burdens. Bottom line, the exchange rate management helps in managing policy. Stronger currency also helps in, relative to the best of the world, can actually boost imports. It also aids in controlling inflation. Indian rupee has been the best performing currency versus peer thanks to RBI's moves.
All right, Abhishek, thanks a lot for that. With that, it is a wrap on this edition of Halftime Report. But keep it with CNBC TV 18. Business Lunch will take all the action ahead.